Hello and welcome to another episode of Finance Footnotes. I'm your host, Brent Stransky, joined by my friend, colleague, and co-host, Zach Miner. Today is April 17th. A lot's happened since we spoke last. We're going to dive right into it. And as usual, we'll
What
talk about what's
happened?
going. Nothing happened.
Something
It's funny.
happened.
Nothing really did happen. So let's go to that first chart. It's interesting because if you look, as usual, this is the poll. I pulled this from the Wall Street Journal this morning. You're seeing here the markets have kind of been ultra volatile, you could say, Zach. But here we are about 14 percentage points as of yesterday from the all-time highs. But it's interesting, Zach, and you saw this, but as of Monday, so 2 weeks ago, President Trump had his tariff announcement. Markets were ultra volatile, very uncomfortable, very volatile. And then 2 weeks later, had recovered all of that. So if you just went to sleep or on vacation for 2 weeks and didn't check, things would have looked awfully similar to you 2 weeks later. So Zach and I are going to dive in a little bit about why this happened and what we can do going forward. But the first thing I want to highlight here is that people are just very pessimistic, and I think it's beyond the foundations of the economy, which I'll go over here in a second. I think it has to do a lot with the political energy, negative energy at the moment. So just quickly, the CNN Fear Greed Index is signaling as of yesterday extreme fear. That's its lowest quintile. And then the University of Michigan sentiment survey came out last week, the second most pessimistic in 40 years. Wow. The American Association of Individual Investors survey said bears are double the normal levels. And that's a really crazy level to think about. And then finally, the VIX, which is the fear gauge. That's how you sometimes can measure volatility in the markets. It's above 50, a very, very, very high reading. Zach, what are we looking at?
Yeah, so I mean, just tagging on to that, like it's been a volatile time, a lot of uncertainty. Things aren't great, but I mean, worse than the depths of the Great Recession is what the sentiment is coming in at. Consecutive weeks of bears above 55%. We just had 4 weeks of that, which is worse than it was the entire time during the recession. Now, there were several times during that period where we had back-to-back weeks. You can see there's like a cluster there around that time frame, but never, even through that period, he didn't have four straight readings that were this bad. And I think that it can be somewhat self-fulfilling, right? It's sentiment can lead into decisions about what to buy and how to save, and which can further lead into company earnings and what they're doing. So it can be somewhat of a self-fulfilling prophecy with sentiment. But I was surprised to see that it was basically the worst it's been ever in the readings of this survey.
As a reminder, at the depth of the financial crisis, banks were going out of business left and right. There was tremendous uncertainty. At the trough, the stock market was down 47%, 49%. It was half. I mean, it was incredible. And it lasted like almost 3 years.
Yeah.
So just to remind everyone what it was like 15 or 16 years ago. Okay. So things are very pessimistic. I want to share a couple reasons why I think this is mostly politically driven, which, as Zach astutely pointed out, could in fact be self-fulfilling. But there is evidence that the economy remains in strong footing. And I just want to highlight these things because I felt like they're completely lost in the narrative of the visceral political commentary over the last couple of weeks. I think things that typically drive the market were kind of lost in the losing the forest for the trees. So, 2 weeks ago, 2 Fridays ago, the March job payrolls came out. It was 100,000 better than expected. Unemployment rates at 4.2%, much better than expected. Typically, this would be a market moving event, suggesting that people are finding jobs. Economists were surprised because they're expecting tariffs already would start, and the government layoffs would start to affect this number, but much better than expected. That's point number one. Point number two, and this happened last Friday. The inflation numbers came out on Friday, last Friday, a week ago, for March. Again, much better than expected. And if you see this chart here from CNBC, you can go pull it up yourselves. But it's showing you this incredible downward shift in inflation, both core and total overall inflation, significantly less than was expected. Going back to the University of Michigan poll I mentioned, it showed that inflation, did you see this, Zach? Inflation assumptions are the worst they've ever been in 40 years.
Yeah.
Yeah, we'll see what happens. The tariffs are, we'll talk about them in a moment, but at the moment, things look very good. I mean, this is the ideal position if you're dealing with this type of volatility. We're already seeing a lowering in inflation. So hopefully that will continue. I've got some thoughts on that. I know, Zach, you've got some great slides on that as well.
Certainly certainly having a good foundation for
Mayhem,
where,
volatility,
yeah.
concern.
So, and it's almost a shame because we really kind of got to almost the end of the road of everything we've been talking about for the last, 2, 3 years of like, can we get inflation down to near target without triggering, recession? And those two data points you just showed are really like we had gotten to the end, the end of the yellow brick road, right? We had almost gotten to Oz here, and you know, we had to throw a wrench in things, but.
Things are getting complicated, but hopefully you're an astute financial advisor for you folks home and had you in a diversified portfolio and you're not suffering the trials and tribulations of the markets. So I want to, before I turn over to Tariffs, I want to talk about two optimistic outcomes here because I think everything's been so pessimistic as we've already talked about. The first one is from Carson Wealth. They're market commentators and investment firm, and they had this interesting chart. Zach, I'm sure you've seen this, but so 2 weeks ago, when President Trump announced his tariff, markets fell off a cliff for two straight days, down 10% on Thursday and Friday together. And then the next week, he had, he announced some untightening of the stress, I guess, and markets rebounded 8% or something like that. Anyway, that's very uncommon to have a large,
More than that.
mature stock market like that outside of a recession, move like this. And so the chart I'm showing you is, I think, something like a little over 20 times there have been a 5% move in the stock market in one day, which we had last week. And so this is going back to 1970. This is, over 50 years of data. And so you can see here on the percentage gain, and then it's looking at the next day return, the next 5 days, 3, 6, and 12 months. And I think it's very intriguing that this is an indication of buying pressure, right? Are things overbought or oversold? And Zach, please correct me if you think anything needs to be added there. But as you move past the 1 day, 5 day, 1 month, 3 month, as you get to 6 months, you can see that 70% of the occurrences are positive with a median return of 8.1%. But as you get to 12 months from that 5% move or greater, which we had last week, you'll see here that something like 91% of those occurrences, which a little over, there's been 20 occurrences or so, with a 21% median return. Zach, did you see this? This is really astonishing. Astonishing. It just really surprised me that this could be an indication of better outcomes in 12 months.
Yeah, I mean, and typically those, because we know we've looked at this, these charts before that, if you miss the 5 best days in the market, 10 best days in the market, you essentially give up all the return. And those best days tend to cluster around the worst days. When volatility happens, it's not just downside volatility, it's upside volatility. And this was 2 days after some of the worst days we've had, back to back 5% down days, and you get a 10% up day. And if you were sitting there on those 5% down days, I just want to step off to the side. I want to kind of get out of things. And then you miss the 10% up day.
Mm-hmm.
And that's a 1 day turnaround. It's not like you have time to assess and say, I think I'm going to get back in now. I think the clouds have cleared. That's just not how it works. And so you really need to participate in these days.
We are long-term investors. If you're, we have to be truthful with yourselves. If you're not comfortable, maybe you have to reallocate your portfolio. But if you have time on your side, which hopefully you do, the next 5 days after that, that's kind of where we are right now. Markets are only higher 40% of the time, but going forward, there's evidence that this could be a good opportunity for markets to improve. Optimistic reason to stay the course, right? That's part of our job here on Finance Footnotes, to give you reasons to stay the course. The next chart I think is even more compelling, which is just talking about the volatility. This is going back to 1990, 35 years of data, which really only encompasses a handful of major economic calamities. So it's not as deep a data set, but there's 75 occurrences here of times that the VIX index, which is the volatility index, measuring one way to measure fear in the marketplace. How choppy are things? How volatile are things? And so the VIX peaked above 50 last week, which again is a very, I guess 74 times Zach isn't that uncommon, but it is certainly signaling that there's pressure or concern or selling pressure in the marketplace. But this is crazy. This is 74 observations 12 months later from the data point going back 35 years. 74 for 74, 100% of the time higher 12 months later, which was really amazing to me. And you can see that the average return over that time frame over a 1 year period was something like, was that 12%? And then going out 100% of the time higher 3 years, 100% of the time higher 5 years down the road. So really interesting data set. I think it's another excuse to stay the course. Zach, did you see this as well?
I did. It also I think it can be a little bit, lies, damn lies and statistics because how many of these 75, 74 times is essentially 2008, right? And
Hmm.
obviously that was kind of the trough of the financial crisis. So I think, and you said at the beginning, right? It's not necessarily a deep data set because it really is almost all one essential thing. And then COVID as well, which is
Hmm.
also kind of an outlier of an event. But that being said, the numbers are the numbers, right? You certainly can um, look back into history, and typically when VIX reaches these extreme levels, those are generally good long-term buying opportunities.
Yeah. Exactly. This is not a guarantee, folks at home. I hope you know that. But I think these are two reasons why, evidence is, leaning into higher markets in 12 months. We'll have to wait and see what happens, of course, and we'll keep you posted here. Zach, if you don't have any other comments on these two important slides, I wanted to just turn a little bit to the tariff conversation
Oh, the
at my
tariffs.
peril.
That's
Um,
funny.
uh, you know, I wanted to start with a little bit of comedy here because I feel like there's been so much. People have been so pessimistic. I must say, like the news feed has been ultra pessimistic. There's been no nothing positive to say. But so I don't know if you saw this. Zach. This was China
This is funny.
escalates their trade policy. So it's a fortune cookie and it says you will not go very far in your life. We've all got those fortune cookies that say you will go very far in your life. Well, China is upset, of course, and now they're really retaliating. Haha. Moving on to the serious stuff. I saw this morning, Zach. Just talking about the trade war deepening, there's been a lot of evidence that the fixed income markets, we've talked about stock markets, but you know what else has been volatile is fixed income, much more volatile than stocks. And so too is the FX currency exchange, wildly, based on its, standard deviations, wildly out of sync. And so the chart here I have is that the US dollar has weakened by over 10% in the last 2 weeks. When you widen out to a 5-year chart, Zach, it's not maybe that far out of whack. But it certainly has been a very seismic move here, and this does put pressure on foreigners. Their imports become more expensive to us, but they're not making as much money. Of course, it's a little bit of more pressure on their side. Do you think this is generally a good thing or a bad thing for American markets?
Well, generally not great and you kind of have to look at the context of the dollar in connection with interest rates. And so if you look back to, the last time it was kind of at this level in 22, interest rates were much lower. This was kind of before we really started to hike. And you can see in 22, going into 23, the dollar and interest rates moved kind of in tandem. Interest rates were going up, dollar was moving up. And interest rates have remained fairly stable while the dollar has started to fall. Typically, those things are pretty together. They move fairly correlated. Um, you know, there there's always a flip side to everything. There's some aspects that make a weaker dollar better and some aspects that make a stronger dollar better, whether it's cheaper to buy imports or cheaper to sell your goods overseas, right? So somebody can always look at the currency exchange rates as being a positive or a negative for their personal situation. But markets in general, and the global, dollar backed order, we generally want a fairly strong dollar.
Yeah.
Um,
For those of us going to Europe this summer with the euro dollar exchange rate higher than it's been in years, not out of this world, but $1.14, it's 3% higher. Not the end of the
yeah,
world. It's just something that's been shaken around a lot. For a country like the United States, such as the United States, that is a debtor nation in terms of trade policy, it does have probably an overall negative effect in the long run. But the big news yesterday that moved the markets was, Chairman Jay Powell, a good friend of yours, my friend Zach. He was at the Economic Club of Chicago, and he kind of gave some comments, probably pretty planned. Listen, the Fed has become ultra politicized, and maybe with good reason, beyond the scope and conversation of our conversation here on Finance Footnotes. But he made a comment here that I thought was really interesting because he said, and I quote, "We are highly likely to generate at least a temporary rise in inflation. And what the central bank doesn't need to do is rush into lower interest rates in the short term." So it had been slated that the Federal Reserve is going to probably do between 2 and 4, quarter point cuts this year in the next 12 months. And now I think that's probably, let's say thrown out the window, but definitely up in the air, Zach. What's your read on that? I mean, this I think was probably the primary thing that moved the market yesterday.
yeah. It was also kind of Nvidia with their additional export controls on their H20 chips, which are supposed to be kind of designed for China, and now there's export controls in there. So that hurt the market as well. But this was definitely
Sure.
a market mover. And if you recall our forecast show, I mean, I was always in the camp that they were going to have 0 to 2 rate cuts. I mean, I didn't think that they were. That was before all of this.
Hmm.
So it's not surprising to me that this is what they're saying. It's what Powell's always been saying. The market has not believed them. But he's really been saying this the whole time. And with that employment number still looking good, he has no reason to rush to cut, right? It's now if unemployment was starting to blow out and that rate was starting to tick towards 5%, well, it's a different story because they have their dual mandate. But even though inflation looks like it is coming down, he's not in a rush to do anything because of the uncertainty of the impact
And for
of
those of you
potential
watching at
tariffs.
home, and you watched our January episode where Zach and I went toe to toe on what the market was going to do this year, Zach said flat to I said it's going to be a great year. So far, Zach has been wildly correct. And then Zach said 0 to 2 cuts this year. I thought more like 2 to 4. So again, Zach is correct, but he does have the CFA. So I think I've got a little bit of a handicap here. All right. So all that to say that the Federal Reserve chair, who's a very smart person, is giving us some reason for pause here. So we'll have to wait and see. We'll report back as to what's going to happen. This
And
rate
the market
does.
will start to price in and start because his term is up next year. It doesn't coincide with presidential terms.
Mm,
So at some point soon, the market is gonna start to see through. It's like, okay, well, who's gonna succeed him? Because it's pretty clear that he's out at the end of his term. Trump is
mm,
constantly on, Truth Social talking about how much, he can't wait to get rid of Powell. So we'll start to, look through what the next Fed chair is gonna start to say. And it'll be a kind of a crossing point where like what Powell is saying will be less important and what the new person is going to be saying is more important. Probably
yeah.
sometime in the fourth quarter of this year, because then that will really
Hmm.
be the how the Fed will move and act going into the back half of 26.
Yeah. Yeah, it's a great point. We'll have to wait and see. We'll have to wait and see what happens. So I think, everything is talking about the from the 30,000 foot view, the tariffs have been broad in scope, and then they were retracted somewhat to be focused mainly on China. And so I just want to highlight a couple points here, Zach, and I think it's important to just remind folks of what matters here in terms of how big the relationship with China is, because that's all we hear about, right? I think if you're at home right now, you're just thinking, well, what is the America's trade as a percentage with China? You'd probably say something like 40 or ish percent just on the things we see made in China, et cetera. But I want to start by looking at the Federal Reserve Bank here. They're talking about the gross domestic product in the country in the U.S. is about 30 trillion. Okay. That's a complex figure, but that's about the size of the economy by one metric. Okay. And then I want to highlight what the volume of U.S. import goods is from China. This is from 1985. And you can see that it's $427 billion that we have in terms of imports, right? So a $30 trillion economy divided by 427 billion. That means that 1.4% of the economy is in trade from from China, right? So I'm just putting into perspective here for us. Seismic, things that could really move the
Good
market
word.
in terms of the movement from China and the policy that the president has at the moment. But I'm not sure if you had the chance to read or hear about this, Zach. But the last chart I have, the last slide I have here, another smart person. We just talked about Jay Powell as a very smart person. Another smart person is Treasury Secretary Scott Bessent. He was, as you may know, for 5 years the CIO of Soros Fund, which is a pariah of the right. So it's it's like Orwellian that this person is the head of the Treasury Reserve and one of President Trump's most trusted allies. Anyway, he did a very interesting interview with Tucker Carlson, formerly of Fox News last week, which was very informative to hear the president's team's side. And he said something which I couldn't verify. I spent some time looking for this study. I couldn't find it. But this is straight out of the Treasury Secretary's mouth. He said, we saw a study out recently from a group at MIT that shows President Trump's first China tariffs, which are about, this is 2018, was about 20%, and the price level went up about 0.7%. So what we're trying to talk about is what is the trade effect? If, there's a 20% trade tariff, what does the American consumer feel? Well, the Treasury Secretary is quoting MIT data, which I couldn't find, that it's, 20% equated to 0.07, 0.7%. So, I think that's a lot less than I thought. He's on the record. I got this data. You can see this is the verbatim from the the treasury.gov, press release. So, he definitely said this. I heard him say it. I think it's definitely lower than anyone else is talking about. And people in the journal, op-eds, etc. They're saying much more than this. But there's a silver lining. It could possibly be a lot less, right? It could be absorbed by China. It could be absorbed by others. So we'll have to wait and see what happens. I guess I'll end by saying I think it's important to take a step back and realize that most of the negativity, most of the pessimism, from my perspective, is politically derived. And I think it's appropriate to just take a step back and take a deep breath, and consider that there are some complex movements at place here. The delivery mechanism through the president isn't ever, always or ever, your choice, depending on where you lean, clean, and it's more like a bull in a china shop. But there is the possibility here for a better outcome down the road. Not that I'm saying that's going to be the case, but I don't think it's being priced in at all at the moment. So
Yeah, a couple things on this Besant quote. So yes, I think he's correct that in general, it wasn't a full one-to-one, pass through, of tariffs back in the first term. You were also coming from a very low base, right? So at some point there is a straw that breaks the back, right? Like you can continue to pile these things on, and there's several ways in which companies can offset the effects of tariffs. And I think that most companies are dynamic, and they're generally able to, reconfigure things to not have drastic price increases. And they could, number one, take it out of their margins. And to be clear, tariffs are paid by U.S. companies, at the border, at the ports. When you import something, if I'm importing something from China, I am paying the tariff. China's not paying the tariff. So let's be just very clear on that first. That being said, I could take it out of my profit margin, right? So I get a 20% tariff, and I have to, on that cost of goods, I have a margin, and I could eat the whole thing and not pass a single dollar on to consumers. I can look for savings elsewhere. And there was a good story I saw in today's New York Times Deal Book letter. It's a morning letter from Andrew Ross Sorkin. There was a good interview with a company called Frameology, I think it was. It was a picture framing company. And they said that they offset essentially all of the cost of the current tariffs that they had, already been in place, with shipping, logistics, and technology. So they reconfigured other areas of their business that reduced cost. They had to pay higher cost of goods sold. Net, it was an even exchange, right? Okay, great. You can do that for a while, right? At a certain point, you can't do that anymore, right? There's just no more room. There's no more things that you can change around within your business that can offset cost. And you're going to have to pass that on to consumers or take it out of your profit, right? Neither one of those things are particularly great for the domestic economy, and for domestic companies. So I do think that to a certain point, the impact can be fairly limited. What we had saw on Liberation Day was a much more drastic increase globally with everyone, than anyone had really expected. And so, the extent to which this, dynamic of, hey, 20% only went up by 0.7, to the extent to which that would persist under this new regime, I think is dubious. So, not to say that every company will be affected the same, because it won't. You can move supply chains, you can look for other suppliers, you can source domestically, you can change things within your business, right? There was a window company that instead of using aluminum frames, they're going to start using wooden frames. Okay, so they changed the entire, characteristics of their product, in order to get around the tariffs, right? So there's a lot of things that
there's a
businesses
lot of things.
can and
There's a
do,
lot of
can
things
and
business
will
can
do.
do, and I think it's a good point. But I think just the points I'm trying to make here. Number
Yeah,
one, you're going to find data to support your argument, and the arguments seem very one-sided to me at the moment. And the
yeah,
second idea I'd share with you is there are no tariff experts. There's, tariffs were a mild variable in 2018. President Biden kept them in place when he was elected. And before that, we're talking about like the tariffs from the 1930s. Like this is new territory. The economy is completely different. So these people that are out there making explanations, we have to be careful about what we hear. I think
Yeah.
this is mostly uncharted territory.
Yeah. And my first chart here is really talking about the myth of tariffs and inflation. I think it's a good segue. Um,
Great. I like
you
good
know,
segues. Let's do
you
it.
know, tariffs are not inflationary in an overall price level sense. They're inflationary on the goods with which the tariffs are on, sure, but what causes inflation is monetary policy. It is the supply of money in the economy, um, and we can see that yes, it's true that back in 2017, money supply was not increasing drastically. Tariffs got put on, inflation did not increase significantly. From 2020 to 2022, we increased the money supply by 40%, and that is why we had inflation. It's very, very clear. We have since, decreased the money supply and then gotten back to essentially pre-pandemic trend of increases in money supply. And so that all looks good. The chart that I'm showing you right now is what's called M2, is kind of the total supply of money in the system. Um, with trillions of dollars on the left hand side, or billions, yes, trillions of dollars, 16 trillion. We started at about 22 trillion in overall money supply now. This is what causes inflation, because if you only have an X amount of dollars to spend and the price of goods with which you are looking to spend that have tariffs on it, the price of that goes up, well, that just means you can spend less elsewhere and prices will decrease in other areas, whether it's services or food or whatever it is, domestically produced goods or other goods that don't have as high of tariffs. And so tariffs can certainly create short-term disruptions in pricing because it takes time for businesses to adjust, demand to adjust for different sectors, different goods. And so that's kind of what Powell was talking about, where they expect a potential short term, and they use that word again. I thought that the Fed would never use this word again, but transitory. They use that again, but this time I actually think it's correct that tariff related inflation really is transitory because it just takes some time for demand to shift elsewhere, to prices to adjust elsewhere. It does not increase the overall level of inflation in an economy permanently.
I think one of the lessons you ought to have, one of the tried and true hard principles you ought to have when investing or in your life, if everyone's saying one thing, there's going to be a recession. We talked about it at October 2022, with 100% certainty, Wall Street predicted a recession that never happened. If everyone's saying it's going to be inflationary, like they're saying right now, extra inflationary, the Fed just said it, right? We ought to be having our ear to the ground and thinking, what could it be? And I think there's a possibility, big possibility that this could be deflationary in nature. The tariffs, if you're buying a Mercedes Benz and the price goes up by 50%, you're not gonna buy it. You're just not gonna buy that car. So I think not everyone at least. So I think there's optics that this could be deflationary. We'll have to wait and see. But
To
it
be
might.
clear, that's not good. Deflation is not good either, right? We don't want deflation.
Well, we don't want deflation.
We
We want
want
less
disinflation.
inflation.
We want
Yeah, we want less
disinflation.
inflation. Yeah. So,
Disinflation is a slowing in the rate of inflation. Deflation is an outright decline in prices in the economy, and that's very bad. You do not
yeah,
want deflation,
yeah.
because if that happens, then consumers. It's kind of the opposite thing with inflation, where if consumers are thinking, well, hey, in 6 months that thing's going to be cheaper, I'm just not going to buy the thing, and then no one
hmm
buys the thing, and then
That's the classic.
there's
That's the classic reasoning. It's a
yes,
complex issue,
yeah,
but the Federal Reserve would avoid that like the plague. So all
yes,
that to
they
say
would.
that everyone's saying it's going to be inflationary. You know, don't be surprised if it's less inflationary.
Yes, I agree with that for sure.
Okay.
This next one, this is kind of just an expanded version of the chart that you showed with the China trade. This is just trade with everyone, with the U.S. U.S. trade balance, just to show that yes, we do have a goods deficit, a goods trade deficit with the world of 1.2 trillion dollars. But that's not necessarily a bad thing, right? There's a reason why we've significantly and drastically increased our stock markets, our general prosperity. Is over the last 40 years. And yes, there are communities and there's whole cities and counties and industries that have not benefited at all and actually have severely been hurt by this trend. but the overall prosperity of the country has been increased by competitive advantage or comparative advantage, essentially that other countries can do things at a lower cost for certain goods than we can do here. And our primary export is services and then also US dollars, right? We export a lot of US dollars as the world reserve currency, but we also have a services surplus with the world of $300 billion. Think Netflix, think Meta, think all of our financial institutions that do business all over the world, right? So we export a lot of
Our elite
services,
universities and colleges
universities and
get lumped
colleges,
into that.
and none of that was taken into account by these trade calculations. And I'm going to spend just a minute on the mat on the this will be the political this will be the piece of the show that may piss people off politically, but that's okay.
You don't have to say it.
It's okay. Because this math is just it's crazy math. It's nonsense math that they use to create these prices that these other companies are charging us. And I put 2 + 2 = 4,764 because it just makes no sense. And I'm starting to maybe think that was the whole point. And if it is, then hey man, they're taking a big gamble that may pay off. I don't know. But what they did, when President Trump held up his big chart in the Rose Garden with all the tariffs that are charged us, they essentially just took the trade deficit with the goods of that particular nation, divided it by the total number of imports, essentially our trade deficit, and created a percentage that said that they charge us 39%. And then like, oh, we're only going to do that, we're going to charge them half of that, which is just not how math works. It's not how economics works. And I think that was the main reason why the market was like, whoa, dude, this is craziness. Nothing about this makes any sense. And the only possible explanation I can come up with is that they're using like the chaos theory of negotiation, that like they're going into these negotiations like, man, this guy, I don't know what he's going to do.
Did you see the meme of President Trump reading The Art of War and then President Z
Yeah.
reading
Read the Art of the Deal. Yeah,
Yeah,
I did.
man.
I know. That was funny. Um, but I think we were all just very, as observers and analysts, were very taken aback by the mathematical and economic affront that this equation was presented to us.
Yeah, especially,
Um,
it's confusing to folks at home, right? I mean, the president came out 2.5 weeks ago on Monday and was like, hey, it's gonna be much less than everyone's worried about. And the market rallied for a couple of days. And then he released his data on Thursday, and it was much worse than everyone was expecting. And trying to see through the reasoning of that is hard for me to do, but I think everyone struggles with that.
well, the reasoning,
The messaging.
yeah, I have no concept of why, except that it has to be that it needed to be high enough to just shock everyone, right? And I think that they just created a number that was going to be high enough that would shock everyone. And I think that's the only explanation that makes sense. Um, and I think some of the people that were around Trump, like Peter Navarro, for instance, one of his trade advisors, he's a tariff true believer. I mean, he really believes this stuff. But then there's like Scott Bessent and Howard Lutnick, who are more kind of traditional Wall Street financial guys. Like they know that this math is nonsense. They're not dumb guys. Um, so I'm hopeful that that's what they were going into this with just saying like, hey, we're going to shock everyone. And it's starting to become potentially clear that the whole goal of this was to box in China. And now we're going to go and have these negotiations with all of our other trading partners with the explicit goal of essentially isolating and
That's
putting pressure on China. And
that's
that could be very possible.
it's almost explicitly what the Treasury Secretary said. I mean, he described it as four-dimensional chess, and I think the frustrating thing for us, anyone on the outside, is we're trying to make observe what's happening and make
Right.
a conclusion, but we don't have all the variables in play. And
Not even
I
close.
think, I think most folks don't realize that China is in a pretty deep recession at the moment. Their economy is struggling. I think all the numbers that come out of there are fake. Most of them,
I
at least, would
no
depend on
idea.
their GDP. It's a
No idea.
joke.
Well,
I
I
think
do think that they probably did have a pretty decent quarter just because people were front running, years worth of purchases, try to get ahead of the tariffs, right? So I think they probably had a decent quarter, this past
mm,
one that just happened. Um, but yeah, you can't trust a single thing that they say because none of it's independently verified.
so I think that all that to say, it would be prudent to maybe give some leeway to the president and his team that there's some outcome here that we're just not privy to. It's, we don't have the details. Um, Not that it couldn't be more polished and kinder, but maybe the outcome will be decent. So I can't believe there's so many variables on it.
So part of our job is to do a little econ 101, right? This is a very
Education.
basic a basic education. So this is just the national accounting formula. This is just the net here is that the sides have to equal, and the bottom portion of this is the important portion. Is that if we're running a budget deficit, we're running a government budget deficit, which we have a massive one, um, and if our general population, our citizens, are consumer based, that means we're spending more than we're saving, you will have a trade deficit. That's It's a mathematical and economic certainty that you will have a trade deficit. And so I just put this up here because the idea that we're gonna solve the trade deficit without solving the budget deficit or magically making all of our citizens stop spending so much or being consumer driven, is impossible. It literally can't happen. So it's really just saying if you're running budget deficit, which is the TG, right? And if your savings isn't large enough to fund essentially that deficit, like if you're a consumer-driven economy and you're spending, then that just means that your net imports minus exports will be negative. That's it. That's all it means. You have to fund your deficit by outside investment. Now,
Mm.
Japan is the kind of opposite end of this, where they also have a deficit, but they save like crazy. They are not a consumer driven economy. And so they actually have a trade surplus because their savings is enough to offset their deficit. Now we're a very different economy. We're a very different, population. So I just, don't worry about don't worry about the letters and this. Just the takeaway is that the trade deficit cannot be eliminated without removing the budget deficit. So those two
Yeah.
things are intertwined. They're interlinked.
Yeah. I mean,
Which, which
in a
yeah,
bold line, if the American consumer didn't buy so many things from overseas, there wouldn't be a trade deficit.
yeah. So, well, no, well, that's not true. It's
That
because
is true.
even that's not necessarily true.
It's
Um,
100% true.
if you have the budget deficit though, um, that means that you have to fund that deficit with outside
No,
capital.
yes, but these are both true. The point I'm making though is that if the American consumer wasn't buying, foreign made products and you
You could
maintain,
you could shrink the deficit that way. You could make it smaller. You can't eliminate it. You could make
of
it
course you
smaller
can. Of course you can. And the
for
point
sure.
I'm making is that, the president's messaging and his shell game of, what's going on. I think it's to appeal to the most broad, folks in terms of explaining the problem.
Yeah, I agree. And the main takeaway is that I think that they know this. I'm hoping that they know all this. And it really is, a distraction technique. It's the chaos theory of negotiation. It's look over here while we're going to actually try to do this
Isolate
thing over
China
here.
and push them
Um,
over the
and maybe
cliff.
maybe that is the whole goal of all of this, right? Is really to isolate China, and that's certainly possible, and I think would have bipartisan support, for the most part.
Don't
So
forget
it's
that President Biden kept first
all yeah,
President
all the
Trump's China tariffs.
all of them. He increased some of them.
Yeah.
So that's not an unpopular position, and they are extremely unfair. Want to talk about unfair, trade practices. China is the worst of the bunch, right? They steal intellectual property, they subsidize industries, they flood markets, they do currency manipulation, all of
They're
the
not they're
things,
not
right?
good actors, and I think there's
All
a
of
real
the things,
problem. Yeah.
but it could be that if they were to come out and just say that, um, then that wouldn't be enough to entice the rest of the world to join that, coalition. And so they had to say, well, we're gonna do this thing here. We're gonna hold this. They're gonna hold this chart up over here. When in actuality, the whole goal was really to get the rest of the world to basically say, hey, we're not going to accept Chinese goods here that can then be funneled to the U.S., which was a problem under the first series of Trump tariffs. And then Besson has talked about this, that they just sent it to Vietnam, right? They just sent it to Cambodia, which then exported it to us to avoid the tariffs. And so that's why we had to put them on everybody, kind of thing. So
Yeah.
there's some method to the madness there, and so
I
I
think
look we
that, in a nutshell of the last 20 minutes, that's it. Hopefully, folks, there's more method to the madness than you're seeing on the nightly news. And
yeah,
that's
for
that's
sure.
probably that's probably true. I would take that bet.
Yeah. All right, so I'm just gonna go a couple of quick things about, like, look, they're taking a bet, right? They're making a gamble because they are playing chicken with the U.S. economy a little bit, because travel and tourism drives a significant portion of the U.S. economy, 10% if you kind of include all the ancillary kind of services. $3 trillion of our 30 trillion is kind of, or 2.5 trillion of our 30 trillion is kind of directly driven by travel and tourism. And if you look at travel and tourism, it's kind of fallen off a cliff, especially from Europe and Asian countries, really have significantly declined since this whole kind of trade situation, started erupting. And you can kind of mirror that with TSA arrivals, which is another indicator of just significantly weakening, travel and folks coming into the U.S. to visit and
And
to do
and
tourism.
building on this, you saw this too yesterday or the day before. CNBC ran an article and was talking about how Europeans traveling to the United States, the plans have fallen off a cliff. And I think
Yeah,
I think politically, Zach, what people are upset about too is like our world standing. I think
yeah,
there's there's a lot of four-dimensional chess going on. I believe that's the case. But one of the cost is not only the cost of the tourism in the United States, but also people are not happy with the United States.
yeah.
And not that that should drive our policy, but I think that's one thing driving people's pessimism at the moment.
Oh, yeah, yeah. Oh, the number of Europeans. Yeah, yep.
Yeah.
So skipping ahead to the volatility in the market. And I think we talked a lot about just the changing structure of the market and how it operates, and how some of these historical comparisons don't necessarily make as much sense in a different type of market, right? I think this is another way that is true. And it's because of the rise of this zero date options. So zero date to expiration, essentially options that get created and expire on the
It's
same
a
day.
casino.
It's a casino. It is extreme trading. It is speculation. It is gambling, right? There's no other way around it. That's what it is. And I think really feeds into these volatile days, making them way more volatile than they otherwise would have been. Because the chart I'm showing right now is just the average daily options volume going back to 1990. And really, for much of the last 15 years, it was fairly stable. In the last 3 years, since we've had this zero date options extravaganza, the average options volume has more than doubled. And if you don't know the mechanics of options when you're buying and selling them, market makers, the folks that are sitting around the screens in New York Stock Exchange and elsewhere, have to balance the books, right? They have to kind of create and reduce liquidity in certain securities and in certain names, in order to make sure that all those things can be settled. And since all of these things are now settling like on a single day, it just creates a lot more trading. It creates a lot more volume, and when things move in one direction, up or down, it just creates kind of a self-fulfilling trend. And now you have now
Volatility
options
increase.
volatility. And so the second piece of this is that uh, the almost the entire increase in those options are all zero day to expiration options. And that's the next chart, just showing that prior to um, 2021, it was really a fairly minimal piece of the pie. And in 24, now it's half of all options are zero date to expiration. And so like, we kind of go and look at, oh, when the VIX has done this and, all the percentages and looking back in the history. And I think there's just another one of those things where some of those comparisons may not make sense anymore because the this is really driving a lot of that volatility, and creating outsized moves other than what they would have really been. And so it becomes almost more of a market mechanics thing rather than like an economic, and that's not to say that these aren't market moving events. They certainly are. But to the magnitude that they're happening, 3,000 points on the Dow, like back to back days, like,
It really, so coming to the quick segue, just to be optimistic, right? They were talking about 5% moves positive since 1950. That chart was since 1950, Zach. I didn't realize. The
yeah,
first observation was 1970. There was one, and then the rest was in 1987. So you basically had 37 years since from 1950 to 1987 with one move 5% up in a day. And then
yeah,
if you look to your point, like the other 20 observations were all like, mostly from 2008 onward. And that's, you see the proliferation of options trading, and especially here now with the COVID era, as well
yeah.
as what we're seeing today, like it's just a different market. It's just changing so
It's a
fast.
different market. Yeah, it's a completely different market. And so like, and I think that's probably going to lead to more volatility in the future. And I think investors can take away from that is like, don't necessarily look at those days as saying like, oh, this is, man, this is just like 2008 or this is just like 2000. It's like, it's not really because this is, it's to a portion, to an extent, it's more mechanics. It's like it's like internal market trading mechanics are driving a lot of these big swings. And so like, trying to compare it to something else in the past may not make as much sense. So I think that everyone can kind of take a step back and realize that this is happening under the surface because it's not like
There have been
talked about,
a lot of I say children, a lot of gamblers have flooded the market. They're doing ultra risky things on these zero date options, and it's
Yeah.
increasing volatility. So your portfolio is changing because these, I see rats are on a ship. But I mean, these people are just gamblers. They're distorting the
Yeah.
markets. They're distorting your portfolios, and we have to be the reasoned players, the rational actors that sit back and just let them do their zero date stuff because they'll believe the long term trend is probably
and
unaffected.
and options are hugely leveraged, right? I mean, that's the big thing is like you don't need a lot of capital to trade options.
These same
Um,
people trading
yeah,
cryptocurrencies,
yeah,
they don't want to hear about a reason, blue chip stock. They want to talk about a cryptocurrency trading under $1, right? That could pop 30% in four
right,
minutes.
yeah,
They're the same folks that want that adrenaline rush.
yeah. And that really these kinds of 20% declines really have binary futures. They either become great buying points or they do lead to some more significant downside, and it's entirely dependent on whether or not it's a recession. And so if this 20% decline happens in the context of no recession, generally that's where it kind of stops. You have, average of declines with no recession of like 28%, but usually it's, low 20s, which is kind of where we were at the lows. And with the recession, they end up being quite a bit worse. And both these charts kind of show the same thing in different ways that I think most analysts that we follow kind of put the recession talk at like a coin flip. I think it's going to really depend on what these next 90 days look like and what happens at the end of that period. Like, do we emerge from this 90 days with a bunch of really good new trade deals? China's its own thing over here. But do we get a new deal with the EU? Does Canada and Mexico, we have some new things? Do we announce a bunch of manufacturing coming back to the US? We actually already had NVIDIA said they're going to build a $500 billion chip factory in the US along with Taiwan Semiconductor, and there was another partner in there. So are we going to see a bunch of that over the next 90 days and like, hey, that kind of worked a little bit? Or are we going to get to the end of this 90 days and none of these things come to pass? And then are we just putting the tariffs back on? Like, what are we doing, right, at
And
that point?
as you're sitting at home, folks, listening to this, great. There's a bifurcated option. That's not in itself very helpful. But I do believe one thing that we should be aware of is there's peak pessimism right now. I mean, things are
For
the
sure.
second most pessimistic in 40 years, which typically means if everyone's feeling pessimistic, the next move is up most of the time. I think that could play out again this time. Outside of the policy outcome, everyone's pricing in, it seems to me, the worst case scenario.
For sure. And I'm still sticking with my call at the beginning of the year. My base case was that we're going to have a flat to down-ish year. I still
Isn't
think
that what
that's
I said too, Zach? I think as
I don't know.
we'll
I
have to
don't know
check the
about that.
film.
I still think that's where we're gonna. I still think that's where we're gonna end up because I do think that what we're gonna see is some deals announced. I think that we are gonna see some trade deals. We are gonna see some lifting of that uncertainty and that cloud. I think that inflation will continue to trend down. I think that employment market will still remain fairly strong, and that we'll finish the year somewhere near where we started it. Yeah, I mean that's I'm still sticking with that call that I do not think that we are going to enter,
So, which to be clear
a
is that you believe
severe
markets
recession.
will improve by 15% ish to end could to
I think
end
so.
flattish for the year. I still think things are going to go positive double digits. I'm going to
Whew.
rephrase that. I think it's positive thing, things go upper single digits, by year end. I think a lot of this is transitory, to use the word that you love so much, and that a lot of the peak pessimism will erode and that cooler heads will prevail.
Yeah, and a couple things I am doing. It
Go ahead.
depends on your personal situation, right? So talk to your advisor about your personal situation. I do have some folks who are taking income, retired, not earning anymore. And for those folks, I am using this current rally to raise some more funds for distributions over the next 12 to 18 months, right? So we don't have to worry about selling something if we do get a downside scenario. For younger growth oriented clients like myself, I'm putting money to work, right? I'm putting cash into the market at these points. I think looking back 10, 15 years from now, I'll be like, hey, those were good prices. Um, who knows what's going to happen over the next 6 to 8 months? So it is very specific to your situation. Talk to your trusted advisor about what that might mean for you.
Yeah, I love that. I don't know what's going to happen over the next 6 to 8 months, you said, but over the next 10 years, you'll probably look back and think, wow, it was a great time to buy this company or, that asset class. So, um,
Yeah, I mean, look, that said, there's a lot of these companies that we had talked about, over the last couple of years are much much less expensive than they were. The whole Nasdaq as a whole, and even if you take out the Mag 7 of the S&P, we're trading at like I want to say 17, 18 times now, which is not expensive really by any standards.
mhm.
So I think we kind of got that valuation reset. We showed that chart about valuations and forward returns, right? And I think we've kind of reset a lot of those bars. I think that those dots will move significantly, just over these last couple months as to where, that forward-looking return starting point is.
Great. Well, with that, friends, there's plenty of ideas there to keep you caught up in the last 4 weeks since we spoke with you last time. We'll keep you posted. If you have questions, please reach out to us and we'll happily answer them or add them to the next episode's subjects. And so have a great time. We'll talk to you soon.
Cheers.